Hello friends, my name is Rocky Outcrop. This is Bitcoin Technical Analysis, and in fact this is one of the more ambitious episodes that I've made. I really do appreciate you tuning in here and joining me for this today, whether that is indeed today, the 12th of October 2020, or at some point down the line in the future, because this episode is going to stand the test of time and it will fit into the education series and help you become a better charting person, a better chartist if you like, a better technical analyst, and thereby help you become a better trader. And the way that I'm going to do that is by linking together several different pieces of the puzzle, which is technical analysis, to allow you to become a better, more rounded technical analyst, and in fact then to be able to link together all the different moving parts and form narratives which actually help you understand the price action at a far deeper level than any individual piece of technical analysis would let you do in isolation. That's a very grandiose target, is it not? Well, it is. And as you can see right now, the prices are in at around about 11,500. If I look in here on the 5-minute chart and zoom on in, you can see that there's this inflection going on around here. There was a key price points come up in this 11,530 area where we have this wick, and so far what we see is the prices are dropping back down below this ever so slightly upward sloping yellow line, and all of this will actually fit together across the time frames to help you understand where we are in terms of the price action. So it's very handy. Today I'll be able to, very handy I say, I'm trying to convince myself that this is an easy episode to make, when in fact it's going to be one of the most difficult episodes I've ever recorded during this whole journey as a YouTube personality. And why is that? Why is it in one hand handy and on the other hand difficult? Well, it's handy because this episode will very, very clearly demonstrate to you exactly where we are in the market and give you a firm handle on understanding exactly what it means to be right here, right now, with the context of where we've come from in order to arrive here. And that will be very useful for people in this moment now watching this episode, if they're watching it just after it came out, and indeed in the following days, for making good trades and assessing the market. But also the lessons that we use to do that right now will demonstrate to people how they can do this at any time, and the importance of linking together different moving parts of technical analysis to create a framework for understanding the price action in order to make your decisions more appropriately and manage that risk. Looking at the prices right now, you can see that they're in 11,500 and that we've been flicking around this area, and of course there's a parallel channel in the background here with this upward sloping yellow line, which is clearly demonstrating to us a really key inflection point in the market. And I'll be using that amongst many other things to build together a picture on how you should really conduct yourself whenever you're looking at the markets. Now, of course, you don't need to do this entire thing yourself, and that just taking little bits here and there will probably permit you to make successful trades and manage them appropriately in order to become a successful, consistent, resilient, self-reliant and profitable trader. However, this is going to be quite the story for us. If I just bring up my object tree, I'll be able to show you precisely why. I've got various support lines, resistance and support lines, an inflection point drawn in as well. I also have Fibonacci's here, which I've labelled X to A and A to D because they also relate to a Gartley pattern. I have wedges, which have got the upper and lower line drawn in. I've got certain building blocks along the way, as you can see with these other wedges, which really build up the picture of where we've been and where we've come from and how we've got here, which is of course of key importance. The expandable broadening wedge as well, which I have on the charts, which I'll come around to at some point later on in the video and show you how that actually encapsulates the price action for where we are in terms of one or two different scenarios. I've got a measuring stick, which I'll sometimes rely on to just make points, maybe not. Building blocks, more of them here, and I've also got mid-level range capturing parallel channels to show us where we have been in the price action recently. So I only started off here in the 5-minute chart just to show you how important this area is just now, of course, with really zooming in on it, because this is going to be one of the main discussion points in this episode. Let me dive up then and to the bigger time frames and put all of this into context for you. And of course, feel free to watch this episode more than once and to kind of absorb the information at your own pace, because this, of course, is going to be quite a lot of information. I will endeavour to keep this video quite short and to the point, and one of the ways I'll be doing that is by not including any information about these oscillators down below, which do get a look in on every single episode that I do on a daily basis. And there is, of course, information to be had within them right now with regards to the price action, but I'll leave that for you to explore. And of course, remember to look back at the previous episodes I've put out, and of course subscribe to the channel so that you can get these informations brought to you on a daily basis. Here we are on the 24-hour time frame, and as I said, I'm just going to use the price action to draw out this story. And as I zoom out here, you can see where we are in relation to these lines that are drawn on the chart. And as I hover over them, you can see them being highlighted over here in my object tree, where I've named them as well. So when the prices came up towards this area in August, we put in a top. And while I said I wasn't going to look at the oscillators, I just want to remind people that, of course, that was a highly bearishly divergent top. And as well, in terms of the structure here, we had this pattern evolving of a head and shoulders in this region, with the left shoulder, head and right shoulder here, and subsequently to it we had a measured move. Now as well, what we also had, just to kind of cast our eyes back at time, was this whole thing forms what has been known in terms of crypto land with as a BART formation, where you have your eat my shorts line over here, and then of course the don't have a cow man line over here on the right hand side. I'm not 100% sure which way around to label those, but you can imagine Bart Simpson's head fitting in here, and that's where that mean, of course, comes from. But this was quite a predictable one. I use that word very, very loosely, and I'd like to remind people again that there is no such thing as a crystal ball in technical analysis, and of course the charts are not predictive. So that's not what we're doing here, although it's going to look like that to the casual observer. This is, of course, a head and shoulders which was quite measurable, and the neckline on it was quite distinct, and as well that's where this inflection point currently comes up. So if I just highlight this, you can see this grey fuzzy line is a key inflection point for us in the market, and really what we're going to be looking for is whether or not we can find support at this zone now. And because we're on this broader view with very little on the charts, I want to point out a couple of things with regards to this line, and this is the start of us putting together a story where everything has an interplay, an interrelationship, an interdependency, if you like, with everything else that we look at. And this is when you get to the real guts and the nitty gritty of where we are in the price action. I honestly believe that the quality that I put out here on the channel is second to none in terms of technical analysis on YouTube, and I hope that this video helps demonstrate that, at least to some extent. So looking back to the left, you can see at this point here on the 19th and 20th of September that the prices came up and touched off that line and then retraced away from them. And then previous to that, you can see how this line also operates with regards to the head and shoulders pattern I already spoke about, in terms of being a neckline when we came and broke down past it here on the 3rd of September. And previous to that, we can see in the formation of this top area that this was quite clearly a support line for us, having previous to that been a resistance line for us. And of course the prices have inflected, if you will, around this area in that period when we were forming out this pattern. Now as well, if I actually zoom right the way out, we can see that there has been historical interaction with this area as well. Back over there, for instance, on the 20th of July 2019, when we had our high, or the 19th of July, sorry, where we had our wick come right up and touch that, and subsequently as well on the 11th of August 2019, where we found support. And as well, I could continue that story going if I wanted to, in terms of our highs over there in 2017, 2018, and then the subsequent area where we came round and touched it again. Now, That is a very, very broad angle, and of course it gives you a nice little bit of context for this grey line that we're looking at here. But the real importance of it for us right now in the here and now is with regards to this price action here. What I would say with a lesson to be taken away from that is that it's always a good idea to look back and see how your inflection points that you're finding in the market have had interplay with the price action historically, as well as we just did there now. Now, if I hide the second support and resistance line here, at this point of this inverted head and shoulders, you could have drawn in a measured move that would have taken you down towards this area over here, where we have our, what I'm currently calling the lowest support line in this range. And looking back to the left, you can see its interplay with the price action as well. For instance, over here in the 6th of May, and numerous wicks in around that area, of course, as well with regards to the lack of an open and close above this line on the 1st of June, and then on the 11th of June when we tested it again, maybe most significantly in the recent past, where we found this wick coming up through it on the 26th of July, only to find that it operated again then as support for us, and when we bust past it in terms of the resistance point of view, we struck on up towards the top side with a very glorious move up the way. And if we did want to, we could look even further back, but I've used just a trend line rather than a horizontal line on this one, so that it doesn't extend the whole way across the price action, just because I didn't want to distract people with regards to the story that I'm building up here by looking back too far, although I've already demonstrated with regards to this grey line how you could do that. Looking down at this, whenever we moved down past this inflection point in the market, we came down towards these lows here as a result of this head and shoulders, but numerous other factors as well, and we found support in at this area, and this of course then can be considered to be our lowest support line. After that point, we also saw that there was resistance coming in here with our body closes in on the 4th of September and such, and at this point here, which we'll call our second support and resistance line. And if you hear blidding in the background, that's the Discord. I'll actually just close that so I don't get too many noises. You're welcome to join the Discord. I'll be doing a voice chat later on there today at 5 p.m. with people to discuss things. 5 p.m. UK time, so that's 9 a.m. if you're in Los Angeles. You can work it out for wherever you are in the rest of the world. You can see here as well, looking back to the left, that it came right in around about this area when we had, of course, these subsequent wicks down the way after the rise up. And looking further to the left, I must still have Discord open because it's still making those blibbling noises. Well, we'll just have to live with it. Looking over to the left, you can see again that this is where the wick came in at for this area in the rise up in the 1st and 2nd of June, having already discussed this little bit of price action with regards to the lowest support line. And then this is where the upper area came in. It was actually another head and shoulders area in and around about the 14th Valentine's Day, February 2020. Then you can see the interplay that exists here between these two lines, and of course a previous Fibonacci, which I'll not go into detail about here in this episode, in and around about a 618 golden pocket retrace. So just coming back down again and reminding people that really what we're looking to here is the interplay of the price action currently, where we are with regards to these three lines really at the moment, as opposed to the historical significance of them. But we have had a brief look there back the way at not only how this has interacted with the price action in the most recent of past, but back in historical sense as well. As you can see, when we pushed past this line here, then we came up towards our key inflection point, which I'm currently calling that at the moment in the market for us. And this has been a very bullish thing so far, of course. And when we came up there, tested that, moved back down the way, found support here ultimately with regards to this second support and resistance line, moved up again, once again retested it and moved up towards the top side. And then we find ourselves currently putting in these prices, which, just to refresh on our memories, is in here right now at 11,486. That's the story in terms of just these three lines, and of course the dynamics that exist between these three lines and themselves, and the price action over the last wee while leading up to this area. But that doesn't cover up the story. That doesn't cover the story. nearly enough. There's a hell of a lot more to look at with regards to this recent price action. And now what we're going to do is put on a couple of Fibonacci retracement points, just so that we can see how things operated between these zones here, for instance, the right-hand shoulder of our inverted head and shoulders area, and the low here, down here to the 1st of September, and then subsequent to that in terms of retracements. Let me first off put on this Fibonacci retracement. Now, if you can see here, the number 1 comes in and it is on the wick here on the 1st of September, and the number 0 on this comes in down here to the 5th of September low. And this shows us exactly where the prices have managed to so far retrace up as high as. And really what we're seeing is that we've come in pretty much up towards this 786 figure over here on the right hand side. And of course the 786 number is going to become important in the story as we go forward here, but we'll bear that in mind when we come to it. What have we done since then? Well, once we came down to this point here, we were able to look at this in terms of a move and how we could retrace against it. Using a Fibonacci, it gives us a lot of context with regards to key areas in the price. And you'll notice that the lower line here, the lowest line, is somewhat above the 0 point, and the second lowest, or middle, support and resistance line here is just above the 236, coming in there at 10,500. Of course, there's a round number factor as well to bear in mind at 10,500, as obvious in terms of the general easy to understand human psychology that people would feel in and around about a big number. But you can see that it exists slightly above this 236. Now, there's a reason for that. The reason primarily being that I'm using wicks here to encapsulate the entire move from the highs to the extreme lows, and you can see then that as we came in here towards this 236 area, that we found this is where our bodies were often closing at around about, and this is where we had a key inflection point, and this zone was obviously important as we were challenging this in terms of resistance area. Now these lines should never be considered to be to the penny. Instead, they should be thought of as being more of a fuzzy concept line, giving you an idea of where the prices could be. By the way, throughout all this, you'll notice that parallel channel, which was visible on the 5-minute chart, is now no longer visible, and I will be putting that back on whenever I talk about the mid-level range capturing parallel channel that we have to explore all of this in a few moments. But then after coming in here and taking out the 236, where did we see the prices rise up to? Well, it came in here just about where we have the golden pocket zone, and of course that lines up here with this fuzzy grey line area, and of course that was another key area for us in terms of inflections in the market, and is a very much important part of the story in terms of harmonics as well. Then subsequent to that, we came back down, and what happened? Well, we tested this 236 again in there at 10,354, finding support on the line, having not managed to close a daily candle below it. Now, it's important as well to bear in mind when we look at these numbers and what sort of time frame significance each one of these things has, is that while we did come down here on the lower time frames, the 4-hour time frame, and put in a lower low just over here, that we didn't really manage to sort of get any follow through subsequent to that. And it just in this point here, I suppose I'll bring the oscillators back on to remind people that between this low and the subsequent low, what we see here is bullish divergence across the board on these 3 oscillators that I have down below on the charts currently, which is the RSI, Stochastics, and the DMI. Of course, there's explanations on how to look at them in more detail on the channel. Just allow me to actually, show this parallel channel again in terms of encapsulating this price action. But let me just dive back up towards the 24-hour time frame and continue where we left off in terms of talking about how on the 24-hour time frame you can see that we didn't actually manage to successfully open and close below this area and get that follow through we were just talking about. Then the prices moved up and they came up towards the 50% area here at 10,955 and retraced back down the way. In around this area last week, I put on an episode which talked about Elliott Wave as well as it happens. Now, Elliott Wave isn't something that I think is the greatest thing ever. I am actually agnostic as to what particular method you use in order to conduct your trading in the markets. Now, there are very, very good advantages to it. However, I would say that that the majority of people, and by majority I mean vast majority, close to 99.999% of videos that you will see on the internet, or ideas shared on TradingView, or indeed articles written in even the prominent and trustworthy, in inverted commas, financial magazines and newspapers, right all the way down to sort of more spurious things like Coindesk, or for instance, will often, more often than not, get it wrong, and their interpretation of it they'll get wrong. But if you want to know about that and how to interpret it, you can watch the episode where I refer to Peter here. Shout out to Peter. And the idea that he presented at that time. We've actually gone up here and touched off of the final wave 5 point, by the way, with this most recent price action with regards to that. Anyhow, we then came up to the 50% area, went back down, and we didn't go as far down as the 236 in terms of our bodies. But what we'll notice here is that we came down and we wicked in and touched it quite distinctly here at this point, and then moved towards the top side yet again, having found support in terms of our body closes here on the 24-hour time frame at our second lowest support and resistance line. As you can see, it gets highlighted there on the object tree on the right as I hover over it. Moving up the way thereafter, we came in here and touched off of this grey fuzzy line, and of course we were thinking about where would things go, where would they not go, and this was of course last Friday before the weekend, and then the price action has gone up towards the top side thereafter. That encapsulates everything that I'm calling at the minute an X to A fib, and we'll cover that of course in detail in a moment. Now, if we then were to consider what would happen if we were to retrace from this point here, where we've come up as high as, down the way thereafter, well, we can absolutely put on another Fibonacci to do that, and I'm going to call this one the A to D fib. And as you can see here, the top of it comes in right at where the most recent price action has been. How handy is that? And the lower area here, oh sorry, it's drawing it in from the 1 is down here on those lows at the 5th of September, and the highs, or the 0 point on this Fibonacci retracement, is up here at the most recent highs. And what do you see here? Well, the 236, it comes in and operates perfectly, lines up perfectly with this grey fuzzy line, which of course highlights for us the key inflection nature of it. Fibonacci retracements become valid once they have moved past the 236. Until such times as that, they can be considered to be invalid. And of course, that's something you'll find difficult to find in terms of people explaining that for you on the internet, anywhere, and in textbooks or anything. I invite you to go and look for it. But if you look here as well with the most recent example, you can see how this became valid as we moved past the 236 and then went up towards these upper targets and back down again, retesting it. The same concept, of course, can apply to this one should we find the prices moving down below this 11,127 key inflection point in the market. Of course, I've been joking with people on the channel saying 11,101, which is of course where the price action closed on Friday with its ultimate high on the Coinbase charts. If you were to look back there, if I just point the mouse up here towards this area where you see the open, high, low and close, it was 11,101.11 exactly on Friday. So, you know, technical analysis certainly does work. But I would hesitate to say to people that you should look to the exact penny points. Of course, these things are fuzzy areas rather than exact pennies. Now, this is important, of course, in defining where we could go to if we were to move down the way. And what we see is with the key area of the 618 golden pocket zone, that comes in precisely where we find our second lowest support and resistance line, drawing in again more confluence with these areas should the price action revisit it. And of course, giving you the idea of a key need to see the prices turn around at that point. Now, at this exact moment, what I would like to do in terms of giving this a little bit more context is to hide all of the drawings off here and point out a couple of key things with regards to market structure. Market structure being, of course, you know, primarily you could say what market structure is looking at the current or previous and historical positions of the price with regards to the key areas in the past where we found highs and lows, and of course then how we operate in between those areas. And looking here, you can see that the market structure point of view means that if we do move up above 11,920, we'd be putting in a high which is higher than the right hand shoulder of this inverted head and shoulders. Of course, if we move down past this 236, then we'd be taking out the wicks of our previous high in there at the area on the 17th and 18th of September. Looking at the prices or the time, I can see this is a 25-minute long video, but this is me trying to really give you an absolute home run. And of course, this will last in terms of the education series, in terms of how you pin everything together and form that narrative. And I've not yet got on to speaking about the other key things to be taken into account. Of course, when you come to doing this yourself, you can do it much quicker than it takes for me to explain it, especially when I'm having to do this as an educator rather than just here operating in terms of trading. This is the sort of thing that when you become expert at, you can do almost immediately in terms of your price action and analysing it and your charting. However, looking here at this area, in terms of structure, we're asking questions about if the prices were to go down past that 236, we're asking questions in terms of the structure with regards to this high over here. But if we do go down to visit that secondary support and resistance line, and of course the 618 zone, and didn't find a turnaround at that point, we'd be taking out our previous higher low, and that would of course change the market structure as well in terms of this 24-hour timeline. Putting the drawings back onto the chart, this is maybe a good time to encapsulate the mid-range of this price action over the last number of months. And if I put this parallel channel on, you can see quite clearly how on the way up here in the 27th, or from the 10th of May, 7th of May highs, the 1st of June highs, that was encapsulated inside of this. Then the lows as well coming in here 11th of June. Then of course the key area, as this perfectly intersected with the neckline of the head and shoulders and moved down the way, how all of this is operated. And what we've seen so far is really that there's been a key interplay with regards to this parallel channel in at the median line here of this, in with movements in and around about this zone, as we can see, moving up and down. And of course that traces the price action perfectly towards the top side, with this top area here coming in and challenging it just now in terms of where we are and should we see any breakouts from this area. Then of course that would change the macro picture, which remains currently with us looking at this and being able to say, well, until such times as we take out this high here of the right hand shoulder, that ultimately what we're putting in could be conceivably a lower high. So until such, because if this was our high, then we had a low, then we had a lower high, then a lower low. Anything up to the point until such times from a structural point of view, you've really broken the previous structural downward movement, you would say that we're still within the bounds of that structure. And of course, that's why you'd have to look at this again as being a key area. Now, I didn't draw that onto the charts here in terms of looking at the inflections because I don't want to overly confuse people, but it's important to draw reference to that fact. Now, if I just hide this again off the charts, how could we easily describe this, and how has it been easily described, this price action in the past with regards to where we've been since the movement down from this right hand shoulder to where we are now, and what could then be considered breaking of this in terms of movement towards the top side, or what could be considered to be continuation for it. And in order to make that story starting off, I'm going to put on a couple of lines which form a wedge. Now, if I put on this upper one and this lower one, you can see that the price structure here, should we come back down towards this zone, but not actually go down to the 618 and instead find support here, would be looking like it's operating within the structure of a wedge and also continuing to put in higher lows and higher highs and revisiting the A to D Fibonacci retracement. If we saw a turnaround at the 382 or indeed perhaps the 50% area as opposed to the 618, then you would say that we're tentatively continuing along the lines of this wedge here. So that adds some more narrative to where we find the current prices. And of course, that's a bearish price action move, a bearish price from charting classical technical analysis point of view. Of course, that's a bearish pattern, and that obviously ties together with the notion of not coming past this from a structural point of view. So you can see the tie together on that one. But how would we describe this movement, therefore, in terms of this? If we were to move down the way, what has this been in the meantime? And what does it mean looking back? Considering that we've been in an upward trend since March up to August, what would this mean if this price action had more significance to it? And how could we relate the story of those Fibonacci areas that we've seen being touched with regards to the X to A fib here on the charts? And a really good way of doing that is to use the Gartley pattern. And of course, this here sums it up quite neatly. Now, I want to give credit where credit's due because I have a very strong dedication and commitment towards transparency here on the channel, and I didn't discover this Gartley pattern here on the charts. Instead, its existence was brought to my attention by Pete Moss, one of the outcropticians. Shout out to you, Pete. Thanks for tuning in if you're watching this. But also, he found somebody else on YouTube talking about that. Now, I didn't watch the person's video who he found that on, so I don't know to what extent they explained any of this. But I hope that you can see from everything that I've said so far how the Gartley really does relate to the price action and encapsulate it. Now, to form a Gartley pattern, what you're looking at is taking a high here, and there's a risk inherent in this structural move here that we've taken it from the right hand shoulder as opposed to from the head over here where we had our most recent absolute high. Our local high in terms of the last 6 months or so has been this area just here. So this is of course an inherently risky approach here in terms of looking at this as opposed to looking at it from an earlier point of view. So that's worth bearing in mind in terms of just looking at this. But I think that's quite obvious given how in depth I've covered the structure of where we find ourselves currently. So of course that is an element of risk there to be accounted for. Drawing in the X point down to the A point, going from the right hand shoulder high on the 1st of September down to the A point here at the lows on the 5th of September, we can then compare that with this Fibonacci, which of course covers the same points, the X and A point, which is why I called this the X and A Fibonacci. And we can look at where this came in at with regards to key areas. Now, this B point came in at around about the 618. Frankly, to be perfectly honest with you, it would have been better had it been bang on the 618. But this is with regards to how we've structured this using the wicks. Now, if I draw this in body to body instead, you can see that that indeed is where the B point is. And we came up and we touched the 618 right there kind of perfectly with regards to that. But I'm going to put this back to the way it was before because of what I was talking about before. Now, of course, this is up to you, and you can choose whichever route or roadmap that you like. If you choose to go the path least followed or the most followed path, as an individual trader who is self-reliant, you're never really going to know objectively which way you're looking at it or not in terms of the popularist approach. So anyhow, this is how I'm looking at it now. We came up and we touched the 618 and we moved down the way towards this C point. And between all of these areas, you can see that there's key numbers drawn out here with regards to the 755 area there, the 768 over here, and of course the 618 line going down here towards where the B point is, showing you that that 618 number here we came off and touched perfectly is indeed the 618 Fibonacci retracement point for when you look at the points A to B with regards to the movement from X to A. And that then we came in and put in what was a higher low. Revisiting the plane look at the charts again, this higher low came in here and says to us, well, hey, you know, maybe we're in an upward phase at the moment. And of course, this pattern here, the Gartley, has a D point, which is up here at the 786, as you can see, more or less perfectly, with that number coming in at 11,500, having just actually touched that today, about 5 minutes before I started filming this episode, which is of course 35 minutes ago or so now, 40 minutes ago now. And that is how a Gartley works. Now, if you want to understand how a Gartley works and why it's important, of course, then you need to be able to put it into the context of what it means in terms of price action, which is what I've essentially been doing in this episode. Now, what type of Gartley pattern is this? This is called a bearish Gartley pattern. So the prediction here in terms of the Gartley and the harmonics then subsequently as furthered by Scott Carney in his book, you can see that the idea at this point would be to find a turnaround potentially here. So you could be managing your risk quite easily with regards to, say you had a shorted it anywhere in around about 10,000 or 11,500, using that area of the D point to really kind of manage your risk. And then any of these points up above could give you an easy enough stop loss area for you, depending on how your particular approach to managing your risk will actually go, and of course your risk levels, though indeed if you're trading on spot or leverage, and several other factors along the way. Looking at this point here, the 786, you could be managing your risk, for instance, at 11,715 if you wanted to, in terms of the 886. Now there is also further ideas that could go into play here in terms of whether this Gartley would eventually become something like a bat and whatever else, but I'm just going to look at it in terms of where we are now. Now the importance, and really essentially everything I've been building up to explaining here, well, the whole thing's an explanation of itself, shows you the interplay between all of the other dynamics in the chart are all that interplay I've explained so far with regards to support and resistance levels, structurally speaking, with higher lows than the previous lows, and of course, you know, overall in terms of are we putting in a lower high, and the debate that you could possibly have in and around this area is indeed neatly summed up whenever you talk about the Gartley, which is why I tend to instead, well, of course, all these interpretations of price action have been written with themselves being put on a pedestal, of course, and saying that this is the ideal way to do it and you should trade exclusively off the back of this information. That it's worth remembering that, of course, that there's a massive interplay and a dynamic that goes between all of these things, and they're not really plucked out of thin air or arbitrarily constructed, and that they are in fact in and of themselves looking at more than just one approach to technical analysis, as I've demonstrated so far with the construction of this Gartley. So to say that you are a harmonic trader and you exclusively look at Gartley patterns and exclusively trade that way would of course be somewhat inaccurate, in the sense that you're overlooking the actual construction and methodology for coming up with these things in the first place with regards to your trading. And of course, in terms of whether or not a pattern works or fails, you have to remain agnostic on it, and that we can then therefore say that this D point here is another key area, for if we push past this zone and the Gartley becomes invalidated, then an invalidated pattern is as much of a tradable event as a validated one. And indeed, it's something to be bearing in mind when you're looking at any pattern, and of course any sort of technical analysis really at all, that if you're anything, you should really aspire to discover quickly when you're wrong and be able to adapt and employ flexibility, rather than to stick to your guns and of course eat the dirt with your position should you let the market move against you, having been sticking to the idea of being right. Being the concept of being right as a trader is one of the quickest ways to lose money. Now, of course, here this D part becomes important, and I think the Gartley more or less explains itself, but it does give you a couple of targets towards the downside if we were to move past, of course, B being the shallowest area in terms of a retracement from the Gartley in and of itself. Now, we've had that price action come in here already today with this B point, and of course we know when we look at the A to D fib going from A to D that is where the 236 Fibonacci retracement point lies. Moving on down the way, structurally speaking, if we were to come down and find a retracement here in terms of your second profit taking target from the back of the Gartley, you'd be looking at the 618 and of course our second support and resistance line. Movements down past that zone, which could remain in it structurally, saying that we've managed to more or less put in a high and a low and then a higher high, if we regard this as simply being flux along the way to that point, which I think it quite clearly is, then you would say that so long as the prices remain above, in terms of body closes, the 786, and in terms of wicks, the 886 point here, which lines up ever so neatly with our lower support line, that you would still be on in terms of an overall upward trend, but that would have absolutely have failed at the point at which you're looking at a movement down past this zone. And of course, then the Gartley pattern will have been showing you the way for that in advance in terms of the structure of markets and the likely movements within them given historical bounds of these things. And then revisiting our mid-level parallel channel, you can see that the next natural target to look to in terms of a low which pushes past these areas would be, of course, in and around this 9,800, 9,700 to up to 10,000 area, really, in terms of movements past this zone, which don't break the overall structure of the March until here upward trend that we've been in. Until it moves past those points there and actually properly closes down past them, you could still make the case that the trend is your friend, and it hasn't quite yet fully bent. Now, just hiding that off the charts again and doing a couple of little sort of building blocks along the way to put all of this price action into context for us. What do we have here? Well, let's put on a building block here in terms of the recent price action where we had a little triangle here. In fact, I called this wedge upper, but I should have labeled that as triangle upper. Sorry, excuse me, as I typed this in wrong before starting the episode. So this triangle here, which led to this price action towards the downside, we had a perfect measured move off the back of that. Please excuse the blooding noise from Discord. Shout out to whoever it is that's chatting there. Love to have community. And that was a perfect measured move off the back of that, which came in at around about these zones, telling you that really, you'd have been greedy to have asked for profit more than the potential for this off the back of that, off the back of a move outside of that zone. Looking at the 4-hour time frame, you can see indeed that it came up to where we would also discussed in terms of fake out zones by coming up and revisiting the previous high and then moving towards the downside, almost getting a full measured move on either side of that symmetrical triangle. Hiding that area and looking at another building block that we had along the way, we had a wedge over here, which then of course could have been and should have been extended up perhaps to these areas, which had a measured move off the back of that, which was completed in it around about this zone here where we came in and put in our bullishly divergent lows along the way here before putting in the C point and moving towards the top side, giving you again greater power of knowing how the markets are moving whenever you're able to fit together a story that goes across more than just one singular myopic approach to technical analysis, and indeed therefore become the master of the charts, which is what, of course, this episode should be allowing you to see how you can do that. Now, there are other things as well that are worth pointing out, and I suppose at this point here I could bring in the idea of the expandable broadening wedge. Now, this was a broadening wedge structure here which encapsulates the lows from after the drop down from the head and shoulders and the movement towards the top side here, and it's these blue lines. If I just hide my other building block wedge along the way here. Actually, I don't think I'll be using that measuring stick that I spoke about before, although if I had have done, it would have been a good opportunity there to kind of drag it around and show you the measurements, but this video is long enough as it is, and you can take it from me that those measuring sticks would, of course, have shown you exactly what we see having transpired in the charts. Now, if we actually drag this along here a wee bit more, in fact, let me just do this on the 24-hour time frame so that it fits in terms of these body closes here. As you can see, this was obviously constructed on that point. What does it take us to in terms of moving it on up the way and expanding it out to cover up where we have this Gartley, and can we get even more confluence with regards to this line? Let me just select it so I can I'm struggling here to grab the right hand side, so what I'm doing just now is expanding the left hand side to get it to go past this horizontal inflection point area so I can drag up towards the top side, and I can show you that if we do move towards the top side and then and stay within this structure overall, and indeed this Gartley were to evolve into some sort of bat instead, and we're looking here at our key area where we have the 1 point of this Fibonacci over here and the right hand shoulder shoulder, if we were to get a turnaround from that point and ultimately put in a lower low, you could be looking at this as being a continuation pattern for the downward movement, which would be a downward trend then that you'd be looking at from the 17th of August down to the September lows in terms of the overall structure of this movement here. And that will actually bring us towards the conclusion for today's video, whereby we are able to say quite categorically that there is certainly more than one way to approach the markets and to understand and to put context on where the price action has been, and therefore to assess how you would enter and exit the market, and of course where the prices could be going and where they could be coming from. Now, to make this of course a little bit more relevant to people who are looking at this and wondering, but Rocky, I thought you said this would not just be a purely educational video and we'd be able to use this in terms of our current technical analysis. Well, of course, the understanding of where we've been and the context of the market structure and the market and the movement so far within this area all show us really exactly everything we'd really need to know to be able to effectively manage trades, even if we were to just reduce this right down to very, very simple mechanisms such as this the A to D Fibonacci point here over on the right. Now, of course, this is measuring stuff from the left here in the actual price action, but I put it on the right for clarity when there's more than one thing on the charts. As you can see, that's why these are over here now, so they don't all overlap as we have this complex story laid out for us. But of course, you could be then managing your risk and trading amongst any of these areas, even taking longs off the back of the 236, given that we have this fuzzy line in here for movements towards the top side, and that might offer you up a rebuy entry. Or, of course, perhaps we could talk about shorting it from this 11,500 area with a view to taking profit at any of those areas down below. Key things to be bearing in mind during this upward trend here, if anything, is to say that the volume has been going towards the downside. As you can see, I have a moving average on my volume. It's quite easy to add that if you haven't got that visible. You just simply have the moving average there, and you can choose your length of your moving average. And of course, you can choose to make it visible somehow, I'm sure, but whatever. And you can see this moving average is moving towards the downside, which makes you see quite clearly that on average there's been less volume coming in around about these areas. Now, if we do move towards the top side and take out our moving average and indeed put in higher volume than we've had recently, that would be positive for the bulls. But currently this is of course negative for the bulls, with this increase in price action contrary to not following through with an increase in actual volume and trading. Now, what else could you do? Because there's innumerable ways of approaching technical analysis, which I haven't even discussed in this video, and it has gone on for 45 minutes. And if you've watched the whole thing, then you're dedicated towards your improvement as a trader, and I hope that this is one of those videos that you'll look back on in time and think, wow, I really started to get things, to be able to understand what it is to really be an independent, self-reliant, consistently profitable, resilient trader. When I watched that video, hopefully you're getting that from this. But there's many, many ways that you could be doing your own technical analysis. I've already mentioned Elliott Wave. How about I take a look at Bollinger Bands then to show you where we are just now with regards to the price action. And bearing in mind as well that I haven't, throughout this entire time, I've had moving averages, which I could have been discussing as well, and I have not done so with regards to not only the levels and the patterns and the market structure, but of course in terms of where we have levels, areas that we could revisit, and different constructs when it comes to understanding the trend, such as the golden cross that occurred over there on the 20th of May, etc., etc., etc. But I'm going to hide that for now, and I'm going to hide off all of the other drawings and simply look at the Bollinger Bands just now. Of course, the way they come out of the box isn't something that I actually like the look of. I tend to change these things over a wee bit so that it becomes more visible for us, which I'm just doing right now, if you can bear with me. Of course, your own preferences are always the key thing to bear in mind when you're doing technical analysis on your own, and to, make sure that you're comfortable looking at the charts. This is how I'm more comfortable looking at them. And what I'm also going to do here is make sure when I look at this that they're behind the price actions, that I can see the candles on top of the Bollinger Bands themselves. And the easiest way to do that, as a quick tip for you, is to go to the visual order of things and say send backwards or send to back. Now, of course, these are at the back already for me, so I don't have the option to hit that button. Couple of key things to bear in mind is that we're tracing this Bollinger Band towards the top side, and that is of course very, very important, and that's what you want to see happen. As we can see here in this area, before we even had that big move towards the top side, that we were tracing it along that way. Now over here, when we got a turnaround, we weren't actually tracing it along. We broke outside of it, came back in, revisited this line, which are 95% chance that you would do, and then of course we came outside of it again, revisited again, and then when we broke back into it, we retested the second standard deviation point away from the 20 moving average here and moved towards the top side there afterwards, and found a little sort of a degree of, in terms of the wicks and everything else, inflection around about that 20th moving average before we came over here towards the top end and moved down. And around these areas here, we of course snaked around that for a while, and now we're moving towards the top side and tracing that again up the way. Movements outside of this area, as you can see where we are just now, could be anticipated with a further withdrawal back to that area. In fact, that means that in terms of the 24-hour time frame, it would be highly anticipatable to have at least 10,500 tested again tomorrow. Should be fine today, closing above that zone. But then if we were to move down past this area, then we could look towards the 20 simple moving average again there at 10,800, and bearing in mind then of course where these things all line up with our technical analysis that we've already done, that movements down past the of course the 618 golden pocket would see us coming in here and back into the bodies of the Bollinger Bands, and of course the 50% area here, movements down past that of course mean that we're going past the 20 moving average basis line of the Bollinger Band, and perhaps then we'd be going down to visit the lower end, which currently comes in at around about that 786 to 886 area. So should we see a turnaround here, then you could imagine that of course that this area that we already spoke about in terms of numerous different things, including for instance the parallel channels and everything else on here, could be coming down and be the next point to where we could see tests coming in at if we have the increased volatility pushing these things apart over the next wee while. But what we have is the expanding of the Bollinger Bands, which of course shows us that the sort of the tightening of the price action has kind of been diminished, and we're waiting to see how the prices all operate in and around this area. We are currently outside of them, and to look back in time, how often have we gone and then pushed very far on beyond without coming back to at least retest these zones again? Then thereafter, well, the last example of it really is here on the BART side on the left, which we spoke about at the very top of this video, and we moved outside and came back and retested it with this wick here again thereafter. Then of course on the way down the way, we came back up and retested it thereafter. Any big shock movement I think would be anticipatable in terms of coming back and retesting that line thereafterwards. And as we look back in time, of course, we get numerous examples of how tracing along the line can indeed lead towards further movements towards the top side, or as well, if I just find another couple of examples of tracing along the line can then start to see a diminishing of that strength of trend if we see the movements back into the body of the Bollinger Bands, and subsequent retests of it not then see continuation towards the downside, but instead tracing towards the middle basis line of the Bollinger Band, for instance. So there's numerous different ways that you could be looking at this right now and approaching your own technical analysis for this section here where we are. But I wish you all the very best when it comes to doing that. I hope you found this video useful, and I hope to the point that you found it so useful to the point that you'd be even tempted to share it with your friends, and indeed discuss it with your friends and talk about how you approach technical analysis and which parts of this overlap with what you're looking at, and if there's been any insights for you in terms of how different measures of the price action relate to each other, as opposed to looking at them in and of themselves in isolation. Now, and other things I haven't spoken about, of course, include the oscillators down below, and indeed the MACD hasn't made a feature onto this video at all, which I use the histogram, not the crossing of the lines themselves. And if I were to just make one final point before tuning out here, then it'll come down in the form of looking at the oscillators and a visit over to the CME charts. So let me do that real quick, and thanks for sticking with me. I can't really believe you've made it to this point in the video unless you are already really dedicated towards becoming a better technical analyst and of course a better trader, in which case you're making all of the right moves right now. Everybody else who tuned out of this thing and has not, dedicated or promised themselves that they'll come back and watch the whole thing are possibly not as dedicated as yourself, in which case, well done to you. I think you're a special type of hero. Looking at this here, you can see that we're in chop plan still in terms of the DMI down below. Dropping down the time frames, you can see that while we get up towards we will go down past the 24-hour time frame down to the lower ones, we can see that there is a strength of trend towards the top side. But of course, we're yet to see that translate into the actual daily time frame. Over here in the 2-day time frame, you can see that while we have had crosses to the positive, they've all happened while the ADX has been under the red, and that while there is this judiciously trending towards the top side movement in terms of the weekly time frame, that we still see the ADX in the orange territory there. There's certain things to be kind of aware of in amongst all of that with regards to your own technical analysis. And I'd also like to point out the bearish divergence that is not visible. Is actually managed to just push past it over the weekend there. I thought we'd maybe have some bearish divergence just at this point here, but we don't really. It's just managed to get away with it. We're coming in here testing the bullish control zone, yada yada, but let's just dive on over towards the CME charts, where I can make a couple of brief points as regards as well here. It's demonstrated, now I didn't know this before looking, but you can see quite clearly yourself that the Bollinger Band has been broken towards the top side, and of course we could have a full measured move off the back of this ascending triangle over here and then go up towards prices such as 12,000, and of course complete a number of different things that we spoke about already during this channel with regards to 11,900 on the spot prices. But there's other things to look to. For instance, there's a gap in here on the 24-hour time frame, and of course therefore on all of the lower time frames as well, with the low end of that coming in there at 11,215. Could that then get filled in, and what would that see happen with the spot prices? Perhaps we come back down and need to find some support at this ascending triangle. Now, as an ascending triangle, how positive and useful is this? Well, because of the close on Friday, you could say that that's what this was, but we've been speculating as to whether or not this is an ascending triangle over the last week, or indeed if this is just a symmetrical triangle that we're looking at here on the charts instead. As such, in which case, if we take this measured move, which hasn't been completed for the ascending triangle, but we look at it here and perfectly position it for this symmetrical triangle and stick it where we've had our breakout, then you can see that we're in amongst having had the completion of that measured move as well. So there's the two sides to that coin, and I'm going to tune out now. I don't see anybody else showing as much dedication to especially such a small number of supporters and followers as myself in the world of technical analysis. And I just think it goes to show that I genuinely believe in all of you as individuals. And I also believe that if you can help one person, well, then it's been a life well led. So I really do appreciate you specifically. When I say that, I'm talking to you directly. Thank you so much for tuning in. I hope this helps you. I hope you have a good week trading. I'll see you later in the voice chat if you choose to join me there. I don't know if this video will get published in time for that. It's 4 o'clock now. I think I'll push it, I'll rush it. I'll do the other videos later on instead. And I hope you have a great day. See you then. My name's been Rocky Outcrop, youtube.com/Rocky Outcrop to share it with your friends. I'll see you next time.